This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Asian stocks are set for a cautiously positive open coming off the US holiday, the dollar edging higher after the worst month this year. Also ahead, Cathay Pacific forced to cancel some flights for inspections of its Airbus A350 fleet over issues with their Rolls-Royce engines. Plus, the CEO of the Taiwanese chip material maker GlobalWafers discusses international expansion plans amid the tech struggle between China and the US. We do have breaking news just crossing the Bloomberg when it comes to inflation readings out of South Korea. The CPI numbers just coming through, and of course implications for the BOK, given that some of the recent weakness in data has really kind of upended some expectations that perhaps we'll need to see a quicker move from the Bank of Korea. That CPI is stripping out food and volatile energy prices up by 2.1%. The consumer prices more broadly, the headline number at 2% gain year on year, slightly softer than estimates of a 2.1% gain. We see prices when it comes to that month-on-month level 0.4% higher. That was bang in line with estimates as well. So, Shery, of course, you know, this comes as really so much fixation is really on not just the Bank of Korea, but really regional and global central banks as to what this last part of the cycle looks like and how to potentially iron out volatility and hit that soft landing.
Yeah, we really have seen the resilience in the South Korean economy, a large part of it coming from exports, right? We saw last month's exports, for example, coming in double-digit growth, finally back, and a huge chunk of that, semiconductors. We'll be watching those chip makers because the South Korean trade minister wants to see some, quote, carrots coming from the U.S. in order for Seoul to comply with that U.S. ban on exports of advanced chips to China. Obviously, that ban could have detrimental impact to these South Korean companies.
And we do, of course, see the very core of that tech sort of bifurcation, the tech war, right? China now warning Japan of retaliation for possible new chip curbs on that front. There's one concern that perhaps Toyota could access or lose their access, I should say, to critical materials under such a retaliation. We know that President Biden has been pressuring Japan to really get in line, to align with possible new US restrictions on Chinese access. And now Beijing threatening severe economic retaliation against Japan if Tokyo further restricts sales and servicing of chip-making equipment to Chinese firms. It's a really complicated picture when it comes to what we see as this US-led effort to cut China off from that key advanced technology. We hear, according to people familiar with the matter, that senior Chinese officials have repeatedly outlined that position, that potential threat in recent meetings with their Japanese counterparts. So Toyota apparently privately told officials in Tokyo that Beijing could react to this by cutting off that access to critical minerals that are essential for car production, not just for Toyota, but certainly a number of other Japanese car makers as well, Shery.
Yeah, we'll be watching those names across the open in Asia because we saw those chip makers across Japan already feel the pressure in the previous session. This is the setup. We're seeing a little bit of downside pressure continue in the Japanese session. Of course, we are seeing Sydney futures really not doing much. We have seen the Aussie dollar also pressured throughout the session. There's also concerns not about just, you know, the U.S. ban on exports of advanced chips to China, but also the Chinese economy overall, and those concerns have led to the offshore yuan also being pressured, although at around a high that we haven't seen in about a year. We are seeing futures in China also under a little bit of pressure. What we'll be following, of course, is the other side of the trade when it comes to currencies. The dollar is steadied overnight, but take a look at U.S. futures setup because, of course, we weren't trading in the Wall Street session. It was a Labor Day holiday, but we'll be looking forward to how we come back online. When it came to Asian stocks overall, we saw a little bit of a retreat. We saw a little bit of a retreat and pressure in the European session. Still, though, global equities hovering near record highs. So U.S. futures really not doing much. We'll be watching oil prices as well. Everything this week, Haidi, will be about the U.S. payrolls number. Are we going to see another bout of volatility like we saw in the July number is a key question.
Let's bring with some views on that. Shery, Nick Twidale, who is the chief market analyst at ATFX, is with us. Nick, really great to see you in person again. And that is sort of the core of what Shery's getting at, right? Are we going to see that outsized reaction? particularly in light of, multiple episodes of pretty severe volatility over the past few months?
I think so, yeah. And sadly for most of us, we're just on Tuesday morning here in Sydney, and we've got to wait till Friday night before we see those non-farms. There's plenty of data coming before. There'll all be sort of small pieces of the puzzle, but really that non-farm payroll, I think it's probably going to come slightly more in line with what our expectations are, which I think is about 164,000. If we do see that, I think that's probably going to start to lock in that 25 basis points rather than the 50 basis points from the Fed. But extra volatility, and then those chances of a 50 basis point cut will really ramp up, and then we should start to see some bigger moves in the market.
So do you see downward from here when it comes to the dollar? Because, so much of that has been the yen story as well.
There has been a lot to that yen side of the story as well. I think we've seen a decent move to the downside. We're sitting at kind of yearly highs for most of the other major currencies. What I'm feeling at the moment is the last 2 or 3 weeks since we saw that sort of crash, the dollar's really depreciated hard. I think it may be slightly overdone because there was so much expectation. For a day we were talking, or a day or 2 or 3 even, we were talking sort of intermeeting cuts from the Fed, which is now just seems a little bit crazy. I think maybe we've slightly overpriced the downside in the dollar and we could see some retraction. But once again, it really is going to come down to what the number is on Friday.
Does it also come down to what happens in November, or do you think politics and the fiscal side kind of is a side story here?
At the moment, it feels like it's a side story, but it's going to come to the fore very, very quickly. We were looking at US elections until sort of the start of this month when things went a little bit awry. Now I think they're going to come back further and further. And just from what we were just talking about here, the geopolitical risks are increasing across the globe, and I think that's going to become a major factor as we move into the end of this year.
What about the yen carry trade story? We saw that unwind happen. Are we seeing investors back and reloading on those yen shorts?
I think there's a decent amount of that going on. Yes, thanks, Shery. I think what we've seen is that the carry trade's still very relevant, and even though there is now we should be seeing the start of that divergence between the BOJ and the Fed. There's still points in it, so I think there's a lot of relevance to it. But overall, I think from an interest rate differential point of view, we're probably more in a sell rallies mode for dollar yen. But we're probably at fair value at the moment, and it will come down to this data, and it will come down to the next moves from the Fed. Well, and I think we're fairly well priced in. Well, we are well priced in. It's going to be a cut just by how much. And the other side of the equation, of course, is what the BOJ is going to do. So I think we were really convinced that we were going to see hikes and quite, not necessarily aggressive, but quite progressive hikes from the Bank of Japan. Latest updates from BOJ officials are maybe they're in a wait-and-see mode as well. And so then it really will come down to data, both out the US and out of Japan.
Should we be then more worried about perhaps a renminbi, the yuan carry trade, given the trajectory of the Chinese economy right now?
I think so, yeah. I think we've got to look at maybe more of the emerging market carry trades for a possibility rather than just the traditional one, which is the yen, which we tend to look at all the time. But having said that, we've probably seen a couple of weeks of slightly more stable trading conditions for dollar yen. I think we might see volatility increase. If these data points come out and they do start to see more volatility in the data, and in fact in geopolitical risks as well. So higher geopolitical risks, I think the yen becomes more attractive. The dollar yen becomes more attractive again. So I think we're going to see volatility into the end of this year.
How do you assess the Chinese economy when we have this continuing weakness, but at the same time, we don't really know what could come out of the U.S. elections, whether or not we get more tariffs, whether or not we get more tightening of these restrictions when it comes to those advanced chips?
I think that's like part of the key question that we need to be asking ourselves when we're looking forward at the Chinese economy. Obviously, data over the weekend didn't help things. We're seeing weakening. We're seeing weakening in the property market over there as well. So it does feel like China's relatively weak at the moment. I think most investors would like to see some stimulus out of the Chinese authorities. That could be key as well. As we know, stimulus tends to be a bit of a short-term knee-jerk reaction. Over the longer term, I think we're probably still in a sell China, buy dollars market. But things could change very quickly. And you know, I keep coming back. It is this data that we're looking at as it comes through the week. But overall, China does seem to be in a bit of trouble. We'd like to see data turning. We'd like to see stimulus, and that should help that economy. Geopolitical risks are massive with that US election. As you were talking before, it really is coming down to another sort of China versus the US and its allies. So it's going to be very interesting. I think we're going to see a lot of volatility again from this geopolitical risk side of things, as well as from an interest rate perspective. So I think there's plenty of moves ahead for the yuan.
There's a lot of flip-flopping when it comes to forecasts for the Aussie as well, and you're a lot less constructive than some of the other people that we've spoken about that kind of point to, you know, sort of commodities demand still holding up quite well. Obviously, there's a steel issue in China that doesn't look resolved yet. But is it the correlation to China exposure that worries you for the Aussie? I
think it is, yeah. I mean, we've always traded, the Aussie's always been trading in line with that China and global growth expectations. To me, that weakness in China should really weigh on the Aussie to a certain extent. Yes, we've got commodities sitting at high, and like gold once again hitting all-time highs and sitting very close to it. But if we do,
the RBA also behind the curve,
and the RBA behind the curve as well. So if we do see a change in 1, 2, or 3 of those perspectives, then I think the Aussie could be one of the currencies that suffers fairly hard.
Nick, really great to see you. Nick Twidale, who's a chief market analyst at ATFX. Coming up in the Asia trade, we'll be talking tech with Neuberger, Berman, Taiwan as a chip war rages between the US and China. Hear why Julius, Baer too expecting more wobbles now that the S&P 500 is almost back to new highs. A little bit later on, we'll be taking a deep dive into Australia's housing challenges, myriad as they are, with Monash University. This is Bloomberg. Israeli Prime Minister Benjamin Netanyahu has apologised for the first time to the bereaved families of murdered hostages after the discovery of 6 bodies in Gaza triggered massive street protests demanding a truce with Hamas. Bloomberg's Michael Heath joins us now for the latest, and the visuals were quite stunning, right? Just sort of the swell of rage and grief. He's apologised, but does this indicate sort of any change to the strategy?
My sense is no, Heidi, and of course we're a long way away here, but I mean, it was really a groundswell, you're right, of grief, of anger, of frustration there, it looks like, from Israelis. And he did apologise. He's a very, very wily and smart politician, Netanyahu. He realises that this is one of sort of Israel's central tenets, is it gets back its people, it does what it takes whenever it can, and they did in many respects fail them. And in contacting the families and acknowledging, and apologising like that, it's sort of a little bit unusual for him. And I guess it is his sort of nod of the head that this is sort of a significant moment. But whether it actually changes the calculus, it's difficult to say. I mean, he also came out at a press conference and said Israel must have this Philadelphia corridor, which between Egypt and Gaza, which Hamas has insisted on in order to get some sort of truce deal. And he says, and he's probably right there, that if Israel pulls out of it, it'll never get back there because there'll be too much international pressure. And that'll allow Hamas to keep smuggling. It could even potentially allow them to move the hostages out there. It's probably a bit of a furphy, but nonetheless, he still seems to be sticking to that harder line. So I think the optics, and Netanyahu understands this very clearly, the optics of apologising is an acknowledgement that something significant has happened here. The groundswell shows the public feeling, but he's still got a fairly solid situation in terms of his government. As long as he keeps hooing to the right, that he'll have a majority in the parliament there to maintain his government.
Does he have a solid footing when it comes to international support? We saw President Biden saying that he'd spoken to the family members of Hersh Goldberg Poland, the Israeli-American who was killed. There's deep frustration and grief there. We also saw the UK halting some arms sales to Israel after their review under the new Labour government.
Yeah, totally, Heidi. And I mean, I think it was summed up when President Biden was asked, is Netanyahu doing enough for this agreement? And he just said no. And I mean, I think that sums it up. And I think there's deep frustration in the US with how he's acting. I mean, on one hand, if it was perhaps a different leader of Israel, people might be a little bit more understanding in terms of such a hardline approach. But Netanyahu will compromise when it works for him as well. So it's difficult to know, you know, how much of this is his political survival, how much of this is his seeing the bigger picture and knowing that you know, Israel must do this now, because if it doesn't, this can happen again, and they must put a stop to it now. It's difficult to make that argument though, because they've been in there for 11 months now. It's not a very big area. You know, there's only so many buildings you can bomb, tunnels you can find, all that sort of thing. So, I mean, that's why you've seen in polls that opinion among Israelis about, you know, that the priority must be bringing the hostages back and getting a deal, that has strengthened. It's up over 60% now. So there is a real groundswell of support, just to come back to what you said. Yeah.
Could the ultimate pressure come from financial markets, from just economic pressure? We saw the shekel weaken again.
Yeah, we did, Shery, and Israel's economy is obviously slowing a little bit. But even the strike action yesterday, it wasn't. I mean, it was widespread, obviously, but you know, the court came out and said, look, this has got no economic basis. Basically, and at 2:30 p.m., everyone was sort of told to go back who was still out. Look, markets could, but Israel also has a good deal of support. I mean, people understand what. Governments and politics aside, people do understand that Israel is it's under siege basically in many respects, despite its firepower and against Gaza. When you look at the wider region with Hezbollah, with Iran, with the Houthis, and then other groups around there as well in Iraq. I mean, Israel does have a significant, you know, it is under a significant threat. So at some point they are going to have to halt this and get back to doing business and getting the economy going. But I think they've probably got enough leeway for now.
Michael Heath there with the latest on the Israel-Gaza conflict. And here are some of the other stories that we're following. Bloomberg's been told that European officials expect Iran to soon ship ballistic missiles to Russia, while Iran has provided Russia with drones during its war against Ukraine. Sources say the potential missile transfer would mark a worrying development in the conflict. The U.S. and NATO allies have warned Tehran against such a move. Ballistic missiles can fly much faster than cruise missiles or drones with larger payloads. Turkey has formally asked to join the BRICS group of emerging market nations. Sources say President Erdogan's administration wants to bolster its global influence and forge new ties beyond traditional Western allies, while still fulfilling its obligations to NATO. We're told the move also stems from frustration over a lack of progress in Turkey's decades-old bid to join the EU. And key U.S. allies are getting pulled deeper into Washington's push to blunt China's tech ambitions. South Korea says it wants more incentives to encourage compliance with curbs on chip exports. And Japan's now been warned of severe economic retaliation from China. For more, let's bring in our China correspondent, Minmin Lo. Minmin, so what are we hearing could be the actions that Beijing could take from here?
Yeah, we're hearing that Beijing could retaliate by cutting off export of critical minerals to Japan, and that could affect sectors like the automotive industry. And that's why we're hearing that Toyota has expressed their concern to Japanese officials about the impact of Japan yielding to U.S. pressure to limit the sale of more advanced semiconductor equipment to China and to limit the maintenance services that the likes of companies in Japan like Tokyo Electron could offer to China for the gears that are already have already been sold to China. And so this is something that Japan will likely take into consideration, because Toyota does have has been quite involved in Japan's chip policy. They have invested in TSMC's new plant in Kumamoto, for instance, and Tokyo Electron, of course, is the target of these U.S. pressure as well. And we know that senior officials are working or in talks with Japan's officials to really look into strategies to ensure Japan's access to alternative sources of critical minerals, because the last time China had temporarily cut off Japan's access to rare earths, that was in 2010 after clashes in the East China Sea. That has really shaken up Japan's electronics industry. But the U.S. administration is facing a lot of pressure from legislators who are calling on the Biden administration to use any leverage they have to get allies to fall into line, including by saying that they're willing to support tariffs on chip makers abroad that compete for market share with U.S. producers as well. So there's a lot at stake, especially with time of the essence here. All these really need to be put in place before Biden steps down in January as well.
It's interesting we've heard from South Korea looking for what it calls sort of carrots for the US for embracing these curbs on China. Do we see some of these trading partners like South Korea, potentially like Japan, wanting more incentives to align themselves with this strategy?
Yes, South Korea has specifically been calling for more incentives to comply with these new rules because the U.S. is now looking to impose a tighter round of curbs on these AI chips, the high bandwidth memory chips that are used in AI accelerators. South Korea currently already cannot export certain types of advanced semiconductor equipment to China, but they have been in the past been quite successful in negotiating a sort of sweet deal with the U.S. They have in the past been able to get waivers for SK Hynix and Samsung, for instance, to ship their equipment to their plants in China. So they're looking for more incentives right now because South Korea sells about half of its chips to China. So their economies are very interwoven and they want to minimize any impact to the companies there as well.
Bloomberg's China correspondent Min Lo there with the details. There's more on chip technology coming up when the GlobalWafers CEO shares their US expansion plans amid rising tariffs on chip materials. More ahead on the Asia trade. This is Bloomberg. And of course, we're watching when it comes to what the next trigger is going to be for these markets, right? And Shery, you mentioned the latest US data that's expected. Of course, it's a Friday night kind of tradition in Australia to wait for those non-farm payrolls, and whether that is potentially the catalyst that we see when it comes to stock market volatility. This is taking a look at what we can expect when it comes to the September sort of performance over the past 10 years for the MSCI All Country World. Take a look at that September levels of just that fall of 2.5%. So really clearly seeing that September can be quite a difficult month when it comes to risk assets, and it is leaving kind of traders everywhere sitting on the edge. It's not just stocks either. Bonds and gold tend to perform poorly. We've got the jobs data, also the Fed decision, not to mention going into the November election, and that's, you know, also taking into account some of the volatility we could see from the China slowdown.
Take a look at this next chart because it's actually the worst month when it comes to bonds. We have seen that again and again in the past 10 years. 8 out of the past 10 years, we saw September and bonds actually falling. In fact, the September of 2022 was the worst, as you can see there. When it comes to gold, also dropping every time since 2017. And of course, we had already treasuries falling on the Friday session before the Labor Day holidays because we're expecting a huge supply of new corporate bonds this week as the U.S. markets also come online after the long holiday weekend. We have more ahead on the Asia trade. This is Bloomberg. We have breaking news on the Bloomberg when it comes to Venezuela sanctions. We're now hearing that the U.S. is laying the groundwork for new sanctions on Venezuelan government officials. This would be because of Nicolas Maduro's disputed re-election in July. The Treasury Department is close to announcing 15 individual sanctions on these officials that are affiliated to Maduro. The U.S. now claiming that they obstructed the holding of free and fair presidential elections, according to documents seen by Bloomberg. The measures now target these key leaders that the U.S. says collaborated with Maduro to undermine the July 28th vote. A list that includes members of the Electoral Authority, Venezuela's top court, and others. Now, the plans could be announced as soon as this week, and it could also change before they're finalized. So breaking news on the Bloomberg on the U.S. drafting new sanctions against Venezuela. Of course, we'll be watching any impact that might have on oil prices and Venezuelan debt as well. The launch of ChatGPT less than 2 years ago sparked an AI frenzy that fueled talk of a fourth industrial revolution. Silicon Valley names grab much of the attention, but perhaps the bigger changes are felt in Taiwan, where businesses and markets have shifted as a result. More from our tech reporter, Julius.
Taiwan is the home of our treasured partners. This is, in fact, where everything NVIDIA does begins.
It's become a linchpin of the global economy. Taiwan's dominance in advanced chips has grown through the AI boom, creating fortunes in the process. Local industry billionaires are 90% richer since the introduction of ChatGPT in November 2022, while stocks in Taipei have surged. Property prices hit a record high in March, with the biggest gains in the city of Hsinchu, the home of semiconductor giant TSMC. That wealth boom is raising fears some will be left behind.
There is a worsening of income distribution across the board, and I don't see any measure to improve this at the current juncture. Parents take the brunt by helping their kids, buying apartments and so on, but it's not sustainable because the next generation won't be able to do this.
Taiwan's government, though, has set ambitious growth goals, seeking a $1 trillion economy by 2028, with GDP per capita set to surpass that of South Korea next year. Julius, Bloomberg News.
Well, as the chip industry faces the prospect of more tit-for-tat trade measures, one major Taiwanese firm says the solution is expansion. GlobalWafers is the world's third largest provider of essential materials for making semiconductors. The chairperson and CEO Doris Hsu spoke to us about the plans for funding from the Biden administration's signature CHIPS and Science Act.
$400 million for our two expansions in the U.S., one in Texas, which is for 300 millimeter advanced wafer process. Another one is for our Missouri, our SOI, 300 millimeter SOI operation in Missouri State. Both of these two projects together, we got $400 million US dollar CHIPS Act money, CHIPS Act support from U.S. government. On top of this, we also try to apply AMIC, Advanced Manufacturing Investment Credit from the U.S., which will be around 25%. So that's definitely very helpful for us.
Receiving that funding, though, is contingent on meeting certain milestones, and as I understand, the deals of those milestones or the sort of specifications around them are still being ironed out. So where are you at in those negotiations right now?
We just finalized PMT, the preliminary, basically the term sheet we have, both parties have agreed. We are working on the long form negotiation now. So it's not the final long form closing yet. So we're still working on the long form discussion with CHIPS Act office. And
when do you think you'd have the conclusion on that?
I would say that we don't have a schedule, but I think that it's likely that we'll get some good result by end of the year.
End of the year. You are already putting billions of dollars into your investments there.
Yes.
What are you seeing so far in terms of demand for the silicon wafers that are expected to come online?
I think silicon wafer demand definitely will grow in the next several years. Matter of fact, it's growing now, but it's just it's slowly. I'm still very positive for our operation in the U.S. For several reasons. One is that it's more and more. It's not like in the past that customers always rely on Asia fabs. They want to have local supply as well. That's the first reason for resilience reason. And the second reason is that more and more our customer, especially tier one customer, they care so much about ESG. So they want to make sure that their wafers carbon footprint is very environment friendly.
How much is this US expansion plan also about avoiding any possible tariff risk?
Yes, I think that's part of the reason as well. I believe that in the US, not only US but also some other countries, there will be some special tariff. And if you have the operation locally, so that means that we are a global company. We support customer locally. We can avoid from some potential tariff. That's our expectation.
GlobalWafers CEO Doris Hsu with Bloomberg's Annabelle Jewelers there. Staying with chips, let's bring in Sebastian Hao, MD and Senior Investment Analyst at Neuberger Berman. Sebastian, great to have you with us. We're now hearing that China is threatening severe retaliation against Japan if Japan goes ahead and keeps complying with the U.S. ban on those advanced chip exports to China. We're hearing from the South Korean Trade Minister that he wants to see more incentives coming from the U.S. to adhere to this ban. How compliant have these countries' firms been so far?
Well, I think because of the U.S. government, Department of Commerce has adopted a foreign direct rule, so that basically a lot of these foreign countries, if their technologies or equipment or whatever the product there sells to China that had contained any sort of the U.S. technology, or U.S. origin technology or intellectual property, they are not allowed to do it. So basically what we're seeing right now is, I think the South Korea and Japan or even Netherlands, they has been mostly compliance with the U.S. government's foreign policy so far.
Are Washington's restrictions tight enough, or are these firms able to bypass some rules using loopholes? And what would that mean in terms of really supplying these advanced chip-making technologies to China, which is what the U.S. ultimately wants to ban?
Well, I think these countries and companies, they're populous companies, they have to comply with the U.S. Policy and the law. So I think they've been following that. But in terms of the loopholes, it's not about these companies who try to find a gray area, but it's about the customers. A lot of the customers who really over their public destination location in China, they're still trying to find a way, find some loopholes to try to get this equipment, probably through another layer, several layers of the arrangement, start to set up some of the fishy companies, affiliates somewhere in Southeast Asia or somewhere that's not in China, trying to buy something. So there's still some loophole there. But I think the U.S. government, I think I think they're aware of that loopholes and then trying to fix this loophole. As you can see, their movement, their progress in the past couple of years.
Yeah, I can only imagine it's a bit like whack-a-mole in terms of trying to close all of those gaps, right? If they're successful in doing that, how impactful is this on China in terms of how long will it take for them to be able to catch up, to be able to do these things domestically if the curbs are all successful?
Well, I think the curbs has, to some extent, it's been pretty successful, I would say, although there's still some loopholes here and there. But we saw this U.S. Chip curb started in I think 5-6 years ago, since the previous Trump administration, and all the way through the Biden administration right now. So it's more than 5-6 years by now. And what we're seeing is that it's pretty effective, that China has faced a lot of the challenges in coming up with their getting this technology and they try to come up with their own domestic solutions. But a lack of some of the fundamental critical technologies and IP that prevent the nations from easily to capture on their own. They need to build up some of the foundations themselves. So what we're seeing right now is that the gap of the China versus the world and the U.S. has only been widened to a larger gap right now. And I think that would cause even higher difficulties and challenges for them down the road.
Do you see any kind of meaningful policy change depending on what happens in November with the US election?
Well, that's not my expertise, but based on our observation is that I think that both parties, Republicans and Democrats, the only few things that have a strong consensus is is blocking China's technological advancement. So I guess I don't see much of we don't see much of that kind of changes, regardless of who's in charge in the White House after November.
Sebastian, really great to have you with us. I appreciate you giving that outlook, despite, of course, not being a US politics expert. But Sebastian Ho, MD and Senior Investment Analyst at Neuberger, Berman there. Coming up next, Cathay Pacific inspecting its entire Airbus A350 fleet after discovering some engine issues. We take a look at our scoop next. This is Bloomberg. Cathay Pacific says it's being forced to cancel some flights for precautionary inspections of its entire Airbus A350 fleet after discovering issues with some Rolls-Royce engines. Our Bloomberg News aviation reporter Danny Lee broke the story and joins us now. So, Danny, what do you know? What did you sort of discover in this scoop, and what's being affected?
So Cathay had an issue with one of its flights on one of the aircraft, the A350, on Monday at midnight, and an inspection revealed some problematic issues with certain components. And what Cathay has had to do subsequently is check the components across all of the A350 engines that it's operating, and which is made by Rolls-Royce engines. And so that its announcement has subsequently, it said that it has to inspect the A350 fleet wide, and it's an issue that has been not previously found before. And so the concern now is, if Cathay's having these issues, does it extend to other Airbus A350 operators? And there are many of this which are in Asia and across the world. And so given the pain and the headaches for the global aviation industry with numerous aircraft and numerous engine types over the recent years, this is least good news for the aviation industry.
I mean, I was going to say, Danny, what's going on? I mean, it's been 2-3 decades, and it seems that the airline industry cannot really get it together. We've had so many issues with Boeing. What the heck are we going to fly now? So what is the problem with this industry?
I think the pace and the growth we have seen, the insatiable appetite to travel, manufacturers, aircraft manufacturers are pushing at very expensive costs to innovate. And we have seen great advancements in fuel efficiency on technology as a whole. But clearly, when you are operating these big pieces of machinery, there's always going to be issues along the way. We've never had we've always had this situation where there is an issue with aircraft, it can be fixed. But clearly this is a challenge in the near term for the likes of Rolls-Royce, who make these engines. And also, just because this has captured the attention of other airlines and regulators of this issue, and then what maybe happens next. What is the outcome? Is this a solvable short-term issue, or does this require a long-term fix? So clearly everyone's going to be paying attention to Cathay Pacific and the outcome of the findings of this particular issue.
We've seen Air China and China Southern getting their first deliveries of the COMAC C919s, right? I mean, I guess to Shery's point, does this open up a better opportunity for competition for COMAC?
Well, for short-range aircraft, certainly I think airlines generally would welcome more competition, and there has been a growing frustration, right, with the duopoly between Boeing and Airbus in the short-haul space. And so clearly there is a lack of options in the longer-range market, and COMAC is also trying to develop a larger aircraft. But this is really expensive stuff, and COMAC has spent multiples of billions on developing an aircraft for the short-range market, which still is yet to find its feet, and still has yet to win over more than just mainland Chinese customers. So clearly steps are being taken, but I think for the meantime they're just laying the groundwork for what could become not just a duopoly, but a three-horse race.
For somebody who flies this much, you can tell that this really riles me up. Aviation reporter Danny Lee, great to get your insights. Thank you. But here's some of the latest from the corporate front. Volkswagen shares closed higher after it said it's considering unprecedented factory closures in Germany. VW's main target is its underperforming passenger car brand, whose profit margins are getting squeezed amid a transition to EVs and a consumer slowdown. Any shutdowns in Germany would be the first in the company's 87-year history. Tesla's shipments from its Shanghai factory rose for a second straight month in August. Preliminary data from China's Passenger Car Association shows the automaker shipped over 86,000 Model 3 sedans and Model Y SUVs. That's up roughly 3% from a year ago and points to some momentum for the plant following a first half slowdown. Now, market watchers are seeing risks to the recent rally in South Korea's battery supplier shares due to tepid demand for EVs. Our Asia stocks reporter Yu Kyung Lee joins us now with the latest. And Yu Kyung, we've been talking about a slowdown in this EV sector for a while. So what has been driving that rally that we saw behind Korean EV battery shares?
Sure, Shery. So over the past year, we have seen this South Korean battery makers shares steadily declining in the South Korean market. But last month in August, we saw some of the major battery suppliers, such as LG Energy, which supplies to Tesla and GM, and Samsung SDI, saw their shares surge more than 20% from their August low within less than a month. And so this has been the first time in a while we saw these battery makers outperforming the shares of chip makers, which have been rallying throughout this year. So this unusual rally we've seen. And when I talked to fund managers, a lot of them said they've been rotating their money out of the high-flying chip makers to this under-owned South Korean battery makers, which have been seeing really cheap valuations after their steady declines over the past year. So part of what's driving this rally has been the rotation out of chip stocks to the battery stocks as the valuations of this battery supplier have become extremely cheap over the past year.
Does this mean that when it comes to the broader EV industry that we're going to see more of a turnaround?
So things have not been fundamentally changed in the EV industry. The South Korea's largest battery maker, LG Energy Solution, has cut its forecast of the annual sales by 20%, and it also has been slowing down the construction of its battery plant in the U.S. So, and also a lot of analysts said the South Korean EV battery maker will have to go through earnings downgrade for the year 2025. So there has been a lot of the investors in the EV battery makers are going to have to digest a lot of the negative news going forward. Furthermore, the automakers around the world are trying to scale back the expectations of the EV sales because of the weak demand, and there's also the issue of potential, depending on the potential outcome of the U.S. elections, the EV policy change could also affect the battery makers in South Korea and their supply chain. So things have not been fundamentally changing in the EV industry, but the rally has been more like the valuations driven than the fundamental driven, that's for sure.
Asia Stocks reporter Yu Kyung Lee there. Taking a look at battery makers and the EV sector more broadly, but take a look at how we're setting up as we're just about 10 minutes away from the start of cash trading across major markets. We're looking pretty steady. A lot of concerns over these mounting economic growth out of China as we see really kind of broadly Asian stocks poised for a pretty steady open. A little bit of softness there going into the start of trading in Sydney. S&P futures also off by about 0.1%. The average performance over the past 30 years, though, for September when it comes to the S&P 500 and certainly a lot of markets around the world, really historically the worst month and one of the worst for just about everyone else around the world as well. So perhaps expectations are quite low as we get US futures trending a bit lower ahead of the reopening after the Labor Day holiday as well. China stocks will expect to come under pressure as well. Beijing under increasing scrutiny to deliver on more stimulus amid the ongoing slowdown. Small gains though potentially expected for the equity benchmark in Tokyo, also in Hong Kong as as well. So this, of course, ahead of key jobs data out of the US as well. That could be a major factor in whether we do see that repeat of the September or the, as our David Inglis just said, the September woes for risk assets.
This is the Asia Trade. Here is another story that we're following this hour. Democratic U.S. presidential contender Kamala Harris says U.S. steel should remain American-owned in her first comment on Nippon Steel's proposed takeover. She was speaking at a rally in Pittsburgh, which is home to both U.S. Steel and the United Steelworkers Union. President Biden has said he opposes the takeover, but stopped short of blocking it pending a security review. And take a look at the steel-making material iron ore. We are seeing a little bit of upside, but this, of course, after the price of iron ore slumped back below $100 a ton. This to do with, of course, just pessimism over the Chinese economy. Gold also a little changed, but this after we saw bullion trade around that $2,500 level. We saw a little bit of upside, but September pretty bad when it comes to bullion. We have seen it fall for every year since 2017. Oil not doing really a lot, maybe a little bit of upside, but of course we're watching the disruptions, especially to Libyan output against concerns over the outlook for China's weakening economy. So you have those two dynamics playing into the commodity space, Heidi.
Yeah, Shery, take a look at the stocks we're watching when trade opens in Korea, Japan and Australia shortly. And certainly one of the gold miners, or some of the gold miners, I should say, will be in focus. The Aussie miners more broadly, as Shery mentioned, that slump for iron ore below $100 a tonne, the continued pessimism over China's economic recovery prospects, again, weighing across the industrial complex. Certainly Toyota as well on watch. The Nikkei reporting that the car maker is delaying the resumption of output for its 3 suspended models. We're also seeing potential pressure if we see that retaliation from Beijing as well. The market opens the next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. Wall Street was away on holidays, Heidi, but of course we saw global equities hovering near record highs, although a little bit of a pullback in the Asian and European session.
Yeah, historically, September is not going to be great, right? In fact, historically, it's the worst month when it comes to the S&P 500 and one of the worst for some of the other global markets as well. But I guess it all comes down to what we get from that non-farm payrolls and whether that upends this historical narrative.
Yeah, where does the Fed go from here? Of course, a key question as we're also watching some geopolitical tensions. Of course, the semiconductor space, something that we're very much focused, especially in Japan with those chip-related stocks already feeling the downside pressure in the previous session. Bloomberg has heard that China has been threatening more economic retaliation against Japan is if Tokyo adheres to, of course, that U.S. ban of advanced chip exports to China. The Nikkei coming online slightly upside of 0.1% after gaining ground for the last 2 sessions. The Japanese yen has been weakening against the U.S. dollar. We're seeing a little bit more upside against the greenback, but still at around that 147 level. We're watching very closely JGB yields. They're a little bit higher, the highest level since early August. We do have a 10-year and 30-year debt auction coming up, so we'll be watching that closely. We already had treasuries also falling on the Friday session because we have more than $120 billion of new corporate bond issuance just this week. So the sovereign bond market will be in focus this week as well. Take a look at what the Kospi is doing. We're watching those semiconductor related names. Again, the South Korean trade minister saying that he wants to see more, quote, carrots coming from the U.S. to really have Seoul comply with that U.S. ban. So we'll be watching those chip makers. Right now, really not a lot of movement, up 0.2% for the Kospi, while the Korean won holds steady at that 1338 level, Heidi.
Yeah, take a look at the setup as we get into just the first few minutes of Australia coming online. This is a setup. We had a little bit of weakness in that futures session, and we are seeing a pretty flat start to trading at the moment when it comes to equities, at least. Stocks that we're seeing pretty close to that record high there, particularly when it comes to that advancement that we see in Australian banks continue to push higher there. Energy shares also have been boosting that overall gauge as well, even with the volatility and weakness that we continue to see across oil. Also watching Aussie bonds as well. They're expected to see, alongside treasuries, that bit of weakness at the open. We're looking ahead to that key component data for GDP numbers as well. So that'll be kind of the focus when it comes to the second quarter balance of payments data. They include critically net exports. They're due at 11:30 a.m. if you're watching in Sydney. So really suggesting that we could see a bit of a boost when it comes to that export demand element there. I mentioned crude. We're seeing downside there of just about 0.5%. Pretty steady though, as are these concerns over supply from Libya contending with the lackluster nature of the Chinese economy. Shery.
Heidi, let's take a look at the Japanese Open, because our next guest who sees the yen weakening from here because of rate differentials is Mark Matthews. He's head of Asia research at Julius Baer. Mark, great to have you back. Is it just, even if we get a BOJ rate hike, even if we get a Fed rate cut, do the rate differentials just look a bit too wide right now?
Yes, Shery, they do, and they will for a long time to come. And when we look back historically at what the dollar-yen prices itself based on, it is not so much purchasing power parity. If it was purchasing power parity, the yen would be much higher than it is now, because things are extremely cheap in Japan. A Big Mac costs the same in Tokyo as it does in Ho Chi Minh City. But when we look back over history, we find it is the interest rate differentials that make the difference. And our assumption is that the Bank of Japan's policy rate will be 0.5% by March of next year, and the Fed funds rate will be 4.5%. So that's still 400 basis points of difference, which is very wide. And on that basis, we do see the yen weakening.
Yeah, I mean, I have family visiting and we're just eating out, and we're just amazed at how much cheaper Japan is compared to, say, South Korea. But are stocks also cheap? Is that why you think that we're seeing this incredible rally in Japan? Because in your notes you say the case for owning Japanese equities is not so much that Japan is changing. I thought that a lot of people were looking at the fundamental corporate governance reforms that we're seeing here.
They are happening, but I wouldn't make that my base case for owning Japan, because I don't think it's going to change that quickly. It's a very homogeneous society and culture, as you know, and it is changing, but I don't think that's the real reason to own Japan. The real reason to own Japan is there's about 4,000 listed companies to pick from in this enormous market, the second largest stock market in the world. And within those 4,000 companies, you can find very good companies, global brand names, which, by the way, we don't have in the rest of Asia. Apart from maybe Samsung, I can't think of any other truly global brands, the kind that Japan has. And you can put together a basket of those with returns on equity in the high teens. And if you look at their performance versus the US market, they actually have done well. The benchmark indices in Japan, the Nikkei and the Topics, they have not done well over the last 20, 30 years, but they're dragged down by big banks. And good quality Japanese companies do actually have a track record of being good companies to invest in.
Mark, your comments about, whether or not Japan has really changed makes me think of what we've seen with the bid for Seven & I, right? Does this tell you, with Seven & I applying for consideration to be designated as a core type of business in line with, nuclear security, does that tell you, as sort of one of the sort of pieces of evidence, that maybe that protectionist aspect hasn't changed?
Well, I'm not so sure, because just to pick that as an example, when you go into a convenience store now in Japan, you're almost always going to be served by a Nepalese or a Bengali who speaks very good Japanese, by the way. So in a weird way, they are changing, but in other ways, they're still very set in their ways, if you know what I mean. But on balance, I do think coming back to those good quality companies, they're absolutely a good idea to have in a global portfolio.
Do you see good quality companies that you would want exposure to for China?
I'm not sure I'd call them good quality, but China is value. It's the biggest value in the world. And as you well know, value and quality are not the same thing. Value means cheap, and quality means something that's very good. And usually something that's very good is expensive. But in China, there is just so much value. In China and Hong Kong, and I think that it's too cheap, and I think that things could get better under a Trump administration. I think that Trump wants to do a grand deal with China. I think that's his major foreign policy goal, and the Chinese did not react very warmly to his first administration. Of course, their reaction was sort of more anger and arrogance at the tariffs. This time, I think if he extends a hand of friendship, they will shake that hand. And so I see upside in the foreign policy relations, and I see the economy, basically trundling sideways, but not getting worse from here. So if you're buying China, you shouldn't expect the economy to suddenly get a lot better. But with so many companies trading at ridiculous valuations, like the property counters in Hong Kong, their price-to-book ratios are about 0.2, and their dividend yields are in the high single digits, like 8% sort of thing, with no withholding tax, by the way, then I think it is a good idea to own some deep value China, Hong Kong.
Mark, before we let you go, I thought I'd put our question of the day to you, which broadly asks if US tech stocks are going to perform better, or if the broader S&P 500 is going to perform better. And I guess that goes to your assessment of how the sort of economic backdrop and the soft landing story remains intact or not.
Yes, well, since the sell-off a month ago and then the recovery, clearly tech has not led, because the NASDAQ 100 is still 5% below its previous high, and the S&P's practically back at its all-time high. I would just say, looking at the bellwether for that sector, which is NVIDIA, we believe their third quarter guidance is too conservative. They will beat it. And we think that data center build-out will continue at least until the end of next year. And the hyperscalers have their own chip designs, but they don't have the volume to get anywhere close to what NVIDIA does. So just taking that bellwether technology stock as a sort of example, I think the growth is still looking very good for the sector. It's real secular growth driven by artificial intelligence, which, by the way, we don't think is a passing fad. So our bias is still to be in those what we call quality growth stocks in the United States, which means technology for the most part.
Mark, always great to have you with us. Mark Matthews, Head of Asia Research at Julius Baer. Take a look at some of the movers that we're watching early on in the session. Of course, the Asian chip makers are in focus, with the likes of Samsung, SK Hynix, Tokyo Electron amongst the ones that we're watching. We are seeing really broad downside. There are a lot of geopolitical issues to contend with there, not least of which is, of course, the idea that perhaps we'll see some retaliatory action from China towards Japan for possible new chip curbs. So watching the impact there, as well as, of course, some of those concerns about the US wanting to close those gaps. South Korea also interestingly coming out and saying that perhaps there should be more incentives if South Korea was to sort of fall in line with some of these US aligned strategies as well. We are also watching Nippon Steel. We have heard from the vice presidential candidate, the vice president and the presidential candidate for the Democrats, of course, Kamala Harris, joining President Biden in declaring that US Steel should remain domestically owned as run. This is just the latest headwind, of course, for Nippon Steel and that proposed sale of the company to Nippon. We're seeing that little bit of downside there. And also watching the miners as well. expecting to see some upside when it comes to gold miners, given the sort of elevated prices that we continue to see. But iron ore continuing to come under pressure, tumbling back below $100 there. The property woes in China just continuing to deepen. The steel mill situation in China continuing to worsen. We've seen very few steel mills in the country making a profit so far in 2024 on the back of that falling decline story. So prices, Shery, continuing to retreat after we've had a bit of a brief rebound for a couple of weeks.
Yeah, and still ahead on the Asia trade, Haidi will take a closer look at Australia's housing crisis, and this as prices continue rising despite high interest rates. Insights in Australia ahead later this hour. But first, China threatening severe economic retaliation if Japan further restricts sales and servicing of chip-making equipment. The latest on the superpower tech tussle next. This is Bloomberg. Key U.S. allies are getting pulled deeper into Washington's push to blunt China's tech ambitions. South Korea says it wants more incentives to encourage compliance with curbs on chip exports. And Japan's now been warned of severe economic retaliation from China. For more, let's bring in our China correspondent, Min Lo. So, Min, what are we hearing could be some of the steps taken by Beijing?
Yeah, we're hearing that China could retaliate by limiting the export of critical minerals to Japan. And obviously this has huge implications on a whole swathe of high-tech applications, including the automotive sector, for instance. And that's why we're also hearing that Toyota is one of those companies that has raised concerns to Japanese officials about yielding to U.S. pressure. We know right now U.S. officials are in talks with Japanese officials to assuage them of this concern and to look for alternative sources of critical mineral supply for Japan. And in the meantime, Biden administration is also facing huge pressure from U.S. legislators to use any sort of leverage they can on allies to get them to fall in line, including maybe even imposing tariffs on foreign companies, foreign chip makers that compete for market share with U.S. producers as well. And time is of the essence here. The U.S. administration said to be looking to reach a deal with Japan by the end of the year, obviously before Biden steps down as well.
Bloomberg's China correspondent Min Lo there with the details. Volkswagen shares gained as it revealed it's considering factory closures in Germany for the first time in its 87-year history. That's as EU car makers lose ground to Chinese manufacturers in the race to produce EVs. Let's bring in our EV supply chain reporter, Danny Lee. So, Danny, what are we hearing in terms of this, pretty historic decision?
This is a real watershed moment for Volkswagen. As you said, in its 87-year history, it has never closed a factory at its home in Germany. And, given the fact they haven't, it's because there are very strong unions and very robust procedures. And for the longest time now, Volkswagen has proceeded without touching the perennial issue. And we are seeing this evolution from this combustion engine era to the EV era. And there are struggles right now, and it's not just reflective of Volkswagen, but the wider industry, particularly for the European auto majors, specifically Stellantis and Renault. And so if Volkswagen's considering some major and significant symbolic cuts, how does it reflect on the wider industry, right? And so given that European car sales are a fifth lower than pre-pandemic levels, multiple factories are operating at a loss, including Volkswagen's main base in Wolfsburg. These are pretty tough decisions that have to be made in order to see where and how these European legacy automakers survive this EV transition, because right now, as we've reported for many, many months now, EV sales in Europe are pretty depressed. And so when you're making the investments, you're making the transition, it doesn't seem to be working out very well. And when you've got the Chinese EV makers and auto brands breathing down their neck, and given the imposition of tariffs that Europe is trying to put up in order to slow down the advance of the Chinese, clearly Europe and the European brands have to think, how do they respond in the meantime in order to make sure that its business is staying upright?
And what could we see in terms of more retaliation coming from Europe? Not in terms of just losing market share, but because, of course, there has been tensions around China's subsidizing of the industry.
I think we have to just wait and see what impact the latest measures, particularly the tariffs, are going to have. We've got to see wait for that to play out, right? And I think in the meantime, that will be enough to hold the advance of the Chinese EV makers, and particularly the fact that, as we now know, the Chinese brands and the Chinese government are concerned about the tariffs and what they can do to try and mitigate and also work with Brussels in order to have entry into the EU market. And so for that is a bit of a breathing space for the European automakers to try and figure out their own strategy, as they, for now, feels like they are muddling along, and we are seeing in the live issues with how the European automakers are trying to cut jobs. And it's very difficult because it's not just a simple job cuts issue, it's a political issue, and that's a real problematic issue for the likes of Germany as they've been through just the recent local elections.
Our EV supply chain and aviation reporter Danny Lee there. Let's take a quick look at how European futures are opening up in the session. Of course, quite a bit of caution going into those key non-farm payrolls numbers coming out on Friday. But this is the picture, pretty mixed there. Euro Stoxx 50 futures seeing a little bit of softness there. German DAX futures just keeping its head above water. We have seen the European stock benchmark, though, rallying for the past 4 straight weeks. This has been the longest streak since March. So investors to that point have been sort of building in confidence when it comes to what the ECB will do, that they'll cut, and that the global economy is continuing to kind of be on track for that soft landing. Some of the China concerns that are mounting, though, have been weighing on broadly sentiment across Europe over the past session or so. It did leave that previous session a little change there, pairing some of those late losses. We did see regional manufacturing data coming in just slightly above expectations. More ahead on the Asia trade. This is Bloomberg. Israeli Prime Minister Benjamin Netanyahu has apologised for the first time to the bereaved families of the murdered hostages after the discovery of 6 bodies in Gaza triggered massive street protests demanding a truce with Hamas. Bloomberg's Michael Heath joins us now for the latest, and the protests did materialise in, a pretty dramatic fashion. Does this kind of move the needle at all in terms of the war strategy?
Yeah, it's hard to know. My suspicion is not, but I think we have seen, a line has been crossed to some extent in Prime Minister Netanyahu making that apology to the families, because Israel has always been quite famous and known as a country that tries to get its people back, that will do deals. I mean, in the past, it's swapped so many prisoners just to get one hostage released, etc. So it is a real failure, and that groundswell of people protesting on Sunday and then the strike as well. I mean, there's a lot of grief, angst, frustration, anger in Israeli society sort of about the situation. And if you look at the polls, which is sort of reflected in our story as well, that it's almost 2/3 of Israelis, 2 out of 3 Israelis now prioritise a hostage deal over defeating Hamas, whatever that exactly means, defeating Hamas. But I mean, that's up from 40% a couple of months ago. So there is a real movement there. Whether that that can impact government policy. I mean, Prime Minister Netanyahu was quite defiant in his press conference yesterday, saying that Israel must keep hold of the corridor between Gaza and Egypt to prevent arms smuggling, and he called that Hamas's oxygen supply that comes through that. Now, Egypt denies that that's the case, but I think it's fairly well established that there is a lot of arms that come through there. So it's difficult to say it'll move it, but certainly there's a lot of movement in Israeli society. It feels like, at least.
You've talked about the flow of arms, and it's interesting. We've had this UK review over these concerns over breaches of international humanitarian law. war. And as a result of that, they're now sort of suspending some arms sales to Israel.
Yeah, and so Britain isn't a direct supplier. It provides components. So it's not quite as significant as, say, US sales to Israel or whatever, but the signal is strong and it is significant. And I think for the British Labor government, it's very difficult because they had to combat in the past accusations of anti-Semitism about British Labor, etc. So they had to be very cautious on that. But they also do have a soft left group who are really, really obviously upset, as much of the world is, about just this horrific humanitarian situation in Gaza. And so this is sort of their halfway house. That it's not everything that's suspended, but there is some sort of effort there to at least show to their own electorate that we are doing something. This isn't just a simple flow of arms going to Israel without any questions being asked about it. And Israel described the response as disappointing. The decision is disappointing because I guess the question is, does it signal that other countries may follow suit?
Bloomberg's Michael Heath there with the latest on the Israel and Gaza conflict. And here are some of the other stories that we're following today. Bloomberg's been told that European officials expect Iran to soon ship ballistic missiles to Russia. While Iran has provided Russia with drones during its war against Ukraine, sources say the potential missile transfer would mark a worrying development in the conflict. The U.S. and NATO allies have warned Tehran against such a move. Ballistic missiles can fly much faster than cruise missiles or drones with larger payloads. The U.S. is laying the groundwork for new sanctions on Venezuelan officials in response to Nicolas Maduro's disputed re-election. Bloomberg has seen documents showing the Treasury Department is close to announcing 15 individual sanctions on officials accused of undermining the July vote. Venezuela, meanwhile, has ordered the arrest of rival presidential candidate Edmundo Gonzalez for alleged crimes, including forging a public document. Turkey has formally asked to join the BRICS group of emerging market nations. Sources say President Erdogan's administration wants to bolster its global influence and forge new ties beyond traditional Western allies, while still fulfilling its obligations to NATO. We're told the move also stems from frustration over a lack of progress in Turkey's decades-old bid to join the EU. And take a look at how Toyota shares are trading at the moment. Of course, we are watching its restart of production. They suspended some of their production of models because of a typhoon that hit Japan. They are now restarting 3 of those suspended models. They will resume production when the situation stabilizes as well. We have more ahead on the Asia trade. This is Bloomberg. The launch of ChatGPT less than 2 years ago sparked an AI frenzy that fueled talk of a fourth industrial revolution. Silicon Valley names grab much of the attention, but perhaps the bigger changes are felt in Taiwan, where businesses and markets have shifted as a result. More from our tech reporter, Annabelle Drolers.
Taiwan is the home of our treasured partners. This is, in fact, where everything NVIDIA does begins.
It's become a linchpin of the global economy. Taiwan's dominance in advanced chips has grown through the AI boom, creating fortunes in the process. Local industry billionaires are 90% richer since the introduction of ChatGPT in November 2022, while stocks in Taipei have surged. Property prices hit a record high in March, with the biggest gains in the city of Hsinchu, the home of semiconductor giant TSMC. That wealth boom is raising fears some will be left behind.
There is a worsening of income distribution across the board, and I don't see any measure to improve this at the current juncture. Parents take the brunt by helping their kids, buying apartments and so on, but it's not sustainable because the next generation won't be able to do this.
Taiwan's government, though, has set ambitious growth goals, seeking a $1 trillion economy by 2028, with GDP per capita set to surpass that of South Korea next year. Annabelle Drolers, Bloomberg News.
Obviously, AI chip demand grabs a lot of headlines, but other parts of the semiconductor industry look far less healthy. GlobalWafers is a major provider of essential materials for chip making. Their chairperson and CEO, Doris Hsu, shared what's holding back a recovery in that sector.
There are two factors. The first one is inventory correction continue. Many of our customers' inventory is still high. And the second is that the legacy components, legacy products demand is not really as strong as the AI-related, those advanced products. I think the growth is mainly for specialized products and advanced applications.
And what sort of advanced or specialized products are you looking at in particular? Are there certain applications, for instance?
The strongest one is definitely AI-related, like GPU or HBM, special memory, or DDR5, some memory-related, and data center-related application. Those are strong. Those are very strong.
Specialty products, what's the margin improvement as opposed to a more standard silicon wafer? How much more money can you make from these?
Specialty wafers, in general, overall gross margin is very close to ordinary one. It's not really, actually price is much higher, but cost is higher as well, because the volume, the scale of that specialty product is smaller than the ordinary wafer. So price much higher, but cost is also much higher. So the gross margin percentage is very close.
GlobalWafers is a company that's really grown through acquisitions.
It is.
Are you looking at any more M&A activity then to build out these capabilities?
We are, in the past 20 years, GWC was basically more than 80% of our growth was from M&A. But starting from 2022, we changed our policy because we found that it's more and more difficult to do any cross-border M&A, and it's also more and more difficult to get advanced technology through M&A, because now more and more countries or governments consider semiconductor as one of the very important core competence or the resilience of national security level. So I think it's more and more difficult. So starting from 2022, we changed our policy from M&A focus to organic growth focus. That was why starting from 2022, we have our expansion in 6 countries at the same time, starting from 2022.
Would you say that was a lesson then from the attempted acquisition of Siltronics in Germany?
Yes, it is. That was that's the result. I think the Siltronic lesson, that the whole cycle, it took us a lot of time and resources, but the result was definitely not what we expected. So the lesson we learned is that it's not the right timing for cross-border M&A, and it's getting more and more difficult to get approval from government. So we decided to make it more organic growth.
GlobalWafers CEO Doris Hsu there speaking with Bloomberg's Annabelle Drewler. Take a look at how we're tracking when it comes to Asian markets at the moment, and there's quite a bit of caution, of course, ahead of the non-farm payrolls numbers due out on Friday, but we are seeing some upside there for the Nikkei 225. The Kospi also trending a little bit higher there. The inflation numbers that we had earlier in the morning decelerating more than expected to that 2% pace in August, slowing to that target that's nudging the BOK ever closer to a policy pivot. We also had recently this week, of course, the prices when it comes to sold apartments, and some of that data also starting to come down as well. So a key component when it comes to those inflationary pressures are starting to cool as the BOK molds that potential policy pivot. That 2.6% gain in July has now slowed to 2% in August for consumer prices, and we do really see kind of a little bit of amplification with base comparisons, given that we did see price growth surging higher on energy costs in particular, but that should lend through to a little bit of support when it comes to the risk sentiment as we get into what is historically quite a difficult September of seasonal trading for global risk assets. More ahead on the Asia trade. This is Bloomberg. Australia is in the grips of a well-documented housing crisis as home prices continue to climb with demand still outstripping supply. The latest data from property consultancy CoreLogic showing the imbalance driving prices higher across capital cities. Perth led home price gains in August, followed by Adelaide and Brisbane. Our next guest thinks this housing anxiety has turned the great Australian dream into the great Australian nightmare. Joining us now is Kevin Bell, who's the Adjunct Professor at Monash University. He previously served as a Justice of the Supreme Court of Victoria. He's also the author of the book Housing, the Great Australian Right. Kevin, really great to have you with us. And to be fair, we're referring not just to one single crisis, right? You talk about the four aspects of the housing crises that we see in Australia, which is not just affordable dwellings, but also rental, as well as social housing. And then ultimately, you know, all those failures lead to homelessness in a lot of instances. What do you see as being sort of the systemic policy failure here?
The systemic policy failure is that government has withdrawn so far from housing as a policy priority, and therefore from the human right to housing as a policy priority, that the system has failed due to underinvestment, undercare across a long period of time, certainly since the year 2000. Before that, really, working backwards through the various sectors of the system that you described, homelessness is very large in Australia, 120,000 people plus. That's higher than other countries with whom we compare ourselves. Social housing, which should be accessible to those without the capacity to pay or rent on the private market, has been run down for a very long time. Waiting lists are huge. Those on the list are forced into the private system, which they can't afford anyway. The rental sector is in a dire state because rents are so high that they're unaffordable to ordinary people, and the tenancy laws here are not fit for purpose. Unfortunately, residential tenancies here is seen to be a second-class kind of housing. It shouldn't be, and we have second-class tenancy laws which need to be reformed. And then, of course, we come to the main element of the system, which is private housing. And there, look, I can summarise it this way. In this country, two people on good jobs can't afford to buy a home anywhere near the population centres. They have to move much further out in order to have any hope at all. If they do buy a home, then it's at the cost of what we call housing stress, which is that they have to pay much more of their weekly income than they really can afford. So that in a nutshell is the four dimensions of the system, and they're all in crisis.
The problem, as you say, but also, of course, has been wildly beneficial for the broader economy, is that housing is primarily seen as an investment asset now, right? How do you unwind that correlation? Because we've seen in, for example, China, how disastrous it is when you try and do that, when household wealth and consumer confidence is so very tied up with property values.
Yes, well, it is a disaster, and a kind of disaster has occurred there, and a kind of disaster is occurring here, and it'll become catastrophic unless something is done. In all countries of the world, the private sector is a significant means through which the just aspirations of the population for housing, I say the human right that they have to housing, is realised. But the government sets the rules of the game. And the problem in Australia is that the rules of the game have not been properly set, and have been based entirely on profit rather than balanced with the needs of people. That's the fundamental problem. Now, we achieve a proper balance in other areas. It might be said that health, primarily private but strongly supplemented by a public sector, is one example. I could refer to others. So it's a question of the balance here. The balance is so far towards using private housing as the principal means of accessing housing that the rules have been let go. Social housing, being the safety net, has been run down. Rental laws have been allowed to be based on 19th century values. And finally, we haven't invested anywhere near enough in either social housing and especially not in emergency housing for the homeless. So my answer to your question is that the private sector is very important, but the rules within which it operates need now to incorporate the human right to housing as a fundamental guiding principle.
Kevin, Haidi talked about China, and of course we see the incredible homelessness also in the United States. What's changed when it came to the mentality of governments after the Reconstruction period following World War II, where housing was supposed to be affordable, where you were supposed to give access to people, and how do you gain that back? Because this seems to be not only an Australian problem, but a global problem.
It is a global problem, and what is called financialisation is part of the problem. This is the idea that we just treat housing as a commodity like any other. We have capital markets which can invest on whatever terms they like, and treat investment there as if it was the same thing as investing in a mine or in a factory. The ultimate responsibility for this happening is, of course, government, because I stress again, government sets the rules of the game. Now, the rules were very differently set in most countries of the world in the post-war period. In that period, housing was seen to have an important economic purpose, which was to enable economies to reconstruct after the dreadful period of war, during which most economies were directed towards the war effort. So in that time, you see a combination, and I think a happy combination, a happy balance between housing as a fundamental social purpose reflected in a human right on the one hand, and the operation of a functioning economy on the other. For a long time, that balance has not existed certainly not in Australia, not in America, and in many other countries, frankly. So that there is a real need for this to be rethought, not just here but elsewhere. And I might say that the UN Special Rapporteurs on the right to housing have been saying this for many years.
And Kevin, we saw a government sort of temporarily and aggressively stepping in to try to mitigate homelessness during the COVID years, right? What needs to change fundamentally in terms of not only policy, but legislation, so some of these changes can endure?
Yes, Shery, that did happen. During COVID, most countries dealt with homelessness because COVID was a threat to their life and our lives. So government stepped in, which shows that it can be done, but it did not endure. Now, what will endure is a legislative approach, and that approach should be reflected in a housing plan, as it is in Canada. I advocate for this in Australia. And that plan can't simply be based on policy because it won't endure if it is. So the answer for which I'm advocating is a national housing and homelessness plan that is based in legislation and developed over time so that the problem can be beaten in the long run. You refer to government investment increasing in Australia in housing, and it is. But it's not enough to solve the problem over the long run. Legislation will be enduring, I think, and more likely to achieve that.
Kevin, if this is a fundamental human rights issue, which you argue it is, and it correlates to so many different social and health and education, employment outcomes, and so on and so forth, is there a legal remedy? If you put on your KC wig, if you will, do you think there is a way that perhaps that could garner more headlines?
Not in this country. The right to housing or the right to home is not in a national human rights act because we don't have a national human rights act, and we should. That's indispensable, actually, for any policy response to endure. There are state human rights acts in Victoria, in Queensland and in the ACT, and they have the right to be free of unreasonable interference with the home as one of the rights concerned, and that's a good thing. But those acts are not strong enough to enable individuals to bring actions against government in order to compel government to change the system. Now, individual action, I think, against government is especially important for homeless people. I think they should have the right to go to court and compel government to house them on an emergency basis. And without in any way detracting from the importance of individual causes of action as part of the resolution of the problem, I'm really advocating for system change. I'm saying that the government should accept the human right for housing as the central pillar for the operation of the housing system and organise everything around that. That means literally all aspects of it. If that happens, then I think individuals are much more likely to be able to access the housing they need in order to lead a decent and dignified life.
Kevin, we really appreciate your time with us. Kevin Baer, who's an adjunct professor at Monash University, also a former justice on the Supreme Court of Victoria. Well, the RBA's Deputy Governor, Andrew Hauser, says rates are likely to stay unchanged in the near future because inflation is a bit stickier than in the US. Our Australia economy and government reporter, Swati Pandey, joins us now for more. So the easing cycle is really getting started globally. Australia is behind the curve or just hasn't quite gotten there yet?
It looks like Australia is behind the curve. We were late when the inflation broke out globally. It was kind of delayed in Australia. We were slow in raising interest rates. We also raised interest rates at a smaller pace than other countries. So there is a possibility that some months down the line, we will see an easing in inflationary pressures as well. The data is not pointing to that yet. It is still worrying to see some of the services side of inflation being really sticky. And the RBA's assessment is that demand is still stronger in the economy compared to the capacity to supply. So all those factors mean that interest rate cuts are not in the offing as yet.
So inflation has been, as a trend, been cooling. So what does the RBA want to see?
So RBA's target is 2 to 3%, and the inflation number, the quarterly number, is around 4%. We had the monthly inflation report, which for July, and that was at 3.5%. So it's still higher than the RBA's target, but also the monthly inflation gauge is a partial gauge, so it does not include everything in the basket. And in particular, the July number did not include the services side of inflation, which is where the concern is really. So the RBA wants to see some more data to be confident that inflation is moving sustainably in the right direction. So it's not like a month or 2 months of move, but that it's moving sustainably within the 2 to 3% target band.
Our Australian economy government reporter, Swati Pandey there. And we have more every week on Australia Ahead, Tuesdays at 10:40 a.m. if you're watching in Sydney. This is Bloomberg.
Russian President Vladimir Putin has arrived in Mongolia for talks with the nation's leaders, defying an arrest warrant from the International Criminal Court for alleged war crimes. For more, let's bring in Bloomberg's Terence Edwards in Ulaanbaatar. Terence, so what's the view there when it comes to Mongolian locals about this visit?
Yeah, it's still morning here. We're just getting started with the day. It's as usual, it's a sleepy morning, and Mr. Putin hasn't arrived yet. We can look at, there was a little bit of demonstration and protest activity yesterday, but I don't think that is very indicative of widespread feelings. We can look at some polls that show that while Mongolians do believe they need to support Russia, they do see Russia among its top allies. A majority of those polled felt that really Mongolia's stance should be neutral, not in support of the efforts of an invasion into Ukraine. And while looking at social media, you see all range of spectrum. You see dissent, you see support for Putin's visit, a lot of name calling, a war criminal, and things like this.
Well, yeah, and that's my kind of question, Terence, right? How can Mongolia be a member of the ICC where it's obligated to arrest Putin and they're not going to do that? Is this sort of the China influence?
Well, I would say it's the Russia influence. That's definitely the most straightforward. We see, again, that Russia's had a long history of partnership with Mongolia, going back to its independence from China. Definitely, Mongolians look back on the efforts to help Mongolia become an independent country. That's looked on favorably. So we really have to take that into context.
Bloomberg's Terence Edwards there joining us from Ulaanbaatar. That's it from the Asia Trade. This is Bloomberg.